All right, good morning, everyone, and welcome to a brand new week ahead. Now, in terms of the week ahead, I've got both good news as well as bad news. The good news is if we take a look at the Fed's blackout schedule, we are officially in the June blackout period for the Fed, which means that for this remainder of the week and the majority of next week, we won't have to worry about any Fed speak, which is absolutely fantastic news for us. On the bad news side, though, is if you take a look at the calendar, guys, we've got very little to be excited about this week. We get some trade data coming up for the UK, which isn't going to be important, or at least wage data rather. We get US CPI coming up on Wednesday. We've got PPI a little bit later in the week. There's very little on the economic data side to get excited about. In terms of other events, we do have the Worldwide Developer Conference for Apple. Maybe that could be interesting for equities, but I doubt it. And then we also have to obviously keep our ears open for any developments we get between US and Chinese officials. They obviously have their call taking place a little bit later today. So we'll see whether we get some news on the trade side, but that's really it for this week. So I think it's going to be a pretty boring one for the most part. So let's quickly touch on the main event from a data point of view, which will of course be US CPI for May coming up on Wednesday. Now, in terms of this print, what makes this one interesting is if we take a look at what happened on Friday. Friday we had a pretty decent NFP report coming out for the US, right? Showing no signs of an imminent collapse. There were so many participants, so many participants expecting really bad stuff for jobs. Some looking for a number as low as 50 and 60. Obviously on the back of some of the data that we had that fed into NFP, but it's something that we always look at, that difference, that very important difference between the ADP and the NFP. ADP is just such a horrible predictor of where NFP will land, right? Just in the last two prints alone, the difference was 87,000 and 102,000 versus ADP and NFP, right? So this is just another example of why, as a retail trader, we never want to waste time trying to predict where the data will land, right? Even the best of the best of the best out there, think about this. Goldman Sachs, JP Morgan, Morgan Stanley, you name it. They have the smartest literal rocket scientists working for them with the best models, access to the best data, and they consistently get these numbers wrong. So why do we think we're going to be different, right? To say, it's going to be an upward surprise or a downward surprise. That, in my opinion, is a complete waste of time. As a retail trader, we are far better off building out scenarios where we say, okay, what numbers do we think we need to see? Where if we get those numbers, we're going to get a real big reaction from the markets. That is where we want to spend our time with, right? So in terms of coming back to Friday's data, nothing crazy good here. It just shows us that, yes, the US labor market is slowly slowing down, right? It's moderating, but it is nowhere near the collapse levels that some people are anticipating. Look, who knows? Maybe next month we get that 50,000 print or that 40,000 print, maybe even something more sinister. But at least for now, what the data did on Friday, it showed the markets that, hey, that worst case scenario fear that everybody's been looking for, it hasn't really materialized yet, right? Everything is still okay when it comes to the labor market. Even in terms of growth, right? Growth had a very scary number for Q1, but take a look at what the Atlanta Fed GDP Nowcast is showing us for Q2. It's sitting at 3.8% right now, which is just absolutely stellar. So it's a little bit weird, because that whole US exceptionalism theme has been pushed back. Everybody's focusing on Europe, that's the new place to be. They've got their own big, beautiful fiscal plan playing out. All of those things is obviously in the mix. The challenge here is that a lot of the fear factor stuff, like, this is the beginning of the end type of stuff, it hasn't materialized yet. Can the US economy still go into a recession this year? Absolutely. It can happen. Has it happened yet? No. Right? At least in terms of what the data is showing us now, everything is purring along okay. There's not a lot of stress yet. Can things get much worse very quickly? Absolutely. And obviously, we'll be watching the data for that. But right now, the data isn't showing us that. It's not allowing us to make that assumption yet. We need to wait for more data. And with the data that we have right now, everything looks okay. It's nothing scary. in terms of US. So bringing that back to US CPI this week, what happened on Friday with that data that we had, despite the fact that the data was okay, if you take a look at rate expectations, let me just bring in the right tables here. Here we go. The rate expectations on the left is the data that we had before the NFP. Data on the right is the update that we had this morning. Now, if you focus here on the Fed expectations, you'll see that by the end of the year, the markets was expecting 48 basis points of easing, right, by the end of the year for the Fed. Now, after NFP, they're still expecting 46, right? So that better than expected, still decent jobs data did absolutely zero for the market's expectations in terms of Fed cut, right? I read a couple of interesting articles over the weekend saying, oh, better jobs numbers drastically seen, markets drastically cut bets for rate cuts for the Fed. Okay, I'm not sure what numbers they were looking at, but going from 48 basis points to 46, that's not a huge cut in cut expectations, right? They literally dropped just 2 basis points. That's not big. So how this all ties in then with the CPI data coming up, because the data came in good and because the markets are still basically sticking to their same guns in expecting 2 more cuts for the Fed. What this means for CPI is that the beat or the miss, if we were to get one this week, needs to be exceptionally large, right? To see the market shaken out of their view about the US economy and shaken out of their view about what the Fed is going to do this year. It needs to be really big surprises. And if we don't get that, it's probably going to be a nothing burger, which again is why we're not super excited about the week ahead. Now, in terms of expectations coming into this, there's a couple of analysts out there that are expecting upside surprises for inflation. More so on the headline side, but some also saying core inflation. In terms of core inflation, it's expected to tick up mostly down to base effects as some base effects gets rolled over. Markets are expecting a little bit of a lift. But in terms of headline inflation, there is some analysts expecting some upside risk there from tariff-related stuff passing through to the economy, starting to make its way into consumer prices. So that will be focused on. In terms of market reactions, it's going to be same old, I think, in terms of inflation data, right? If we were to see a huge downside surprise in the data, we would expect downside in things like the US dollar. We would expect downside in things like yields, upside in things like equities. If it's the exact opposite and it's a huge upside surprise, we would expect the opposite. Downside equities, upside yields, upside the US dollar. And obviously in this scenario, you would expect gold to move in the same direction as equity. So big upside surprise, you would expect downside for gold. Big downside surprise, you would expect upside for gold. So it's best waiting for it. In terms of positioning data, if we take a look at positioning data, the dollar is still very stretched on the downside. What does that mean? It means that if we were to have a surprise this week, the one that is going to offer us the best chance of short-term directional movement is probably going to be an upside surprise, especially after the better than expected data we had on Friday, and especially after the CFTC data that we have on Friday as well. With the dollar still stretched to the downside, the best chance for a good reaction would be if we have a huge upside surprise, forcing yields up, forcing the dollar up, and obviously seeing a bit of that positions squared up going into the rest of the week. So that would be my preferred play. I did take a long position on dollar Swiss franc on Friday after the jobs data. My theory for this is pretty simple, right? In terms of market internals, let me quickly show you guys what I was looking at on Friday. We do have some internals suggesting that there is upside risk, some upside risk for the pair. Let me just quickly open this up. Just give me a quick second here, guys. Sorry for the wait. Here we go. So if we take a look at market internals, we can see everything from risk reversals to inflation differentials to commodity terms of trade, growth differentials. Everything is suggesting upside risk for the pair. We also know that from a valuation point of view, the Swiss franc is massively overvalued, massively overbought at these levels. At some stage, the SNB won't be able to ignore the negative inflation that they have right now. And we're expecting that at some stage to create some downside pressure for the Swiss franc. So I do like the Swiss franc lower and the dollar higher versus it for as a first step. The second reason, though, is after NFP has now kind of just pushed, has kicked the can down the road, so to speak, it does give the markets a little bit of breathing space, right? To say that, okay, things haven't fallen apart yet. Everything seems to be purring along okay. Earnings season that we just had was okay. Growth data looks okay. Labor data looks okay. Everything seems to be okay for now. And I think that could give the dollar some breathing room. At least, that was what I was thinking on Friday. And coming to today's session, I'm like, okay, fine. It seems like sell the dollar. Regardless of what's happening, we just need to sell the dollar. It seems like that theme is still in play. I'm comfortable holding on to the position going into CPI. But it looks like the markets are still just in the mood to sell the dollar. Like I said, when you look at everything under the hood, there's reasons why I think I want to be a little bit more careful with that view right now. But at the end of the day, price will tell you whether you are correct in your analysis or not. And right now, price is telling me, not yet. So we'll see how this one needs to play out. But for now, in terms of CPI, the best case scenario would be an upside surprise and expecting some upside in the dollar in the short term as a result of that. Now, apart from that, what other data points we have coming up? Look, we've got UK labor data coming up. That's not going to be important. Why? Because the ONS can't be trusted with the data. The ONS doesn't trust the data. That's why the Bank of England doesn't trust the data. And that's why the markets have just been ignoring this data. Out of all of the data, we do have wage data coming up, which is the two components that the markets do still trust, if you will, in terms of the ONS data that we get. Even then, though, I'm not sure how much wage data will need to really change to give us anything new. It's a tricky one. Markets are expecting wages to stay fairly close to where we are now. The size of miss or beat that we would need to really alter the course for the Bank of England would be massive, right? So I'm not expecting us to get there. So it's probably going to be a dud as well. I think in terms of UK events, the one to watch out for the most would be the planned spending review coming up on Wednesday from Chancellor Reeves. I think that's going to be an interesting one. Markets are expecting them to increase spending for both the NHS as well as defense. And the markets are expecting them to basically try and keep their day-to-day spending to grow by just 1.2% annually between 2026 and 2027 and 2028 and 2029. We'll see whether they are able to get there. And they're expecting them to basically take money from things like courts, councils, transport, civil services. Those types of things are expected to get cuts, while they increase things like NHS and defense spending. So what could possible triggers be for that review, spending review? The biggest triggers would be if the markets view what they plan to do as fiscally irresponsible again, right? Think back to the mini budget. If they are planning to do all of these increases in spending in terms of defense, in terms of NHS, but they don't cut adequately from other departments, or they just say that for now we're going to be, funding this with more debt. They would obviously not put it as bluntly, but if the markets look at that review and they say, okay, so you're just going to be making more debt to pay for all these things. If that happens, we are probably going to see yields in the UK, gilt yields pop to the upside. And remember, normally you would associate upside in yields with upside in a currency, right? Because normally yields is dictated by interest rate expectations and inflation and growth expectations. But when it comes to fiscal, responsibility, if the markets views it as irresponsible, yields will go up, but the pound is expected to go down in that scenario. So that is probably the better one to watch out for the UK in the week ahead. If they do come out and the markets don't view them as being fiscally responsible, expect the same type of reaction in the pound like we had with the US dollar, where even though yields went up as fiscal irresponsibility was a concern, we didn't see the dollar moving up, and you would expect the same reaction to yields as well with the pound in mind. So keep that in mind. That's probably going to be the better mover for the pound. If we don't get any surprises from Reeves, though, it's probably not going to be a big market move and something we can ignore. The other one that we can keep on the radar is the Worldwide Developer Conference coming up for Apple. Now, again, I'm not expecting this to be a big mover, to be honest, guys. Normally, what we get from this thing is fairly mixed. Back in, when was it? I think back in was it last year? we had a huge reaction from it. Last year it was all about AI, remember? I think then we had like a 5 or a 8% gain on the back of the conference. If you compare that to what happened back in 2022, when there were more concerns coming out of the conference, then we had a drop of about the same. So it's very mixed in terms of what we can expect. Look, we all know what it's going to be about. The main focus, the main theme is going to be AI. If they are able to surprise and inspire, we probably see stocks going up. If they can't do that, we probably see it pushing lower. This is not an event that I'm too excited about trading. In terms of where we're trading right now, we are miles away from the 200-day moving average in terms of Apple. We've basically been stuck in a very wide range between 214 and 193, basically going back to the middle of April. So I'm not expecting this range really to break, but obviously that is going to be a key focus point for Apple. And because it is such a huge weighting in the likes of the S&P and the NASDAQ, it is something worth watching. But again, I'm not expecting much from that, if anything at all. The other one that we need to watch, like we mentioned, is today we obviously have the US delegation with the likes of Scott Bessent. We've got Howard Lutnick, as well as Trade Rep Greer. All of them will be meeting in London with a Chinese delegation. And on the agenda will obviously be the trade deal, right? Whether they are able to get some common ground will be a key focus point for the markets. That's probably, and unfortunately, that's probably going to be the better driver or bigger driver for volatility potentially this week. If we get any huge good news, right, if it's the best deal ever, right, the biggest beautiful deal that we've ever seen in existence, if we get something like that, or at least good news moving towards it, what would we expect? Upside dollar, upside equities, downside yields, downside gold as well. If it's the opposite, if it's bad news and we don't get any common ground, then they've pushed back meetings, and if it's just an absolute shambles, expect the opposite. Dollar down, yields up, equities down, gold up. That's basically been the trade war game plan so far this year, and I don't expect that to change in the week ahead. So that's obviously the one that we'll need to watch as well. In terms of open positions, I've already spoken about the dollar Swiss franc. That's the only one I'm running in the short term right now for FX. The only one that I changed last week was oil. We had a really good run in oil. The main trigger, I've had so many questions on this one, but it's important to stress that when it comes to oil, my aim with trading this was never down to supply and demand. It was never down to geopolitics. It was all about the volatility, right? When volatility ramped massively to the upside, making, reaching some very interesting levels of expensive, moving into that expensive area, and then rapidly cooled off to the downside, that rejection of vol was my trigger to get long, right? So it's been a volatility play all along. As volatility died down, which was our anticipation, as volatility pushed lower, we expected price to push up. So what happened last week, when I saw volatility do this, I'm like, okay, we're now getting back to levels which is fairly quote unquote normal for implied vol when it comes to the OVX. It's still high, but at 35, you're basically between 30 and 35 is a fairly normal level when it comes to oil vol. That for me was good enough. So when I saw vol pushing lower, now you're getting into a stage where you have more upside potential for vol, meaning downside potential for price. That doesn't mean I want to get short oil here. I'm not saying I want to be shorted. I'm just saying that the reasons for why I wanted to be long basically played out. We reached that key level of resistance where we just struggled to break through a couple of times. I was happy to take that one off the table and basically bank what I had on that one. So completely flat on the oil trade, and that's pretty much that for this week. I will obviously be watching what's happening to the Swiss franc. If we get some SNB intervention throughout this week, that'll be important for us to watch. Obviously, that's going to impact the dollar Swiss franc trade that I'm in. I will be watching US CPI, but apart from that, guys, like I said, it's going to be a pretty boring affair for the most part, and something just worth keeping in mind. If ever you wanted to take some days off from trading, a week like this might not be a bad idea. Obviously, famous last words. Maybe I just say that and we get some monster moves this week. If we do, I'm sorry. But for now, I'm not expecting a lot coming out of this week. So with that said, I hope, as always, everybody has a fantastic week ahead. Any questions, don't hesitate to let me know.